While deposits in the trillion-dollar sector have surged, Fidelity has seen nearly $16 billion in net withdrawals over the past 4 years, according to research firm Morningstar Inc. The exodus stems in part from unease with the way Boston-based Fidelity has boosted performance, by ramping up risk. Instead, Fidelity portfolio managers now try to time market shifts, for instance by moving billions of dollars out of money-losing commodities bets and into Chinese stocks and U.S. tech shares, regulatory filings show. Such changes have worked well in the second longest-running bull market in U.S. history, but they expose investors to bigger losses if the fund's increasingly volatile assets head south. In the 1990s, Fidelity helped pioneer target date funds as a prudent method to diversify investments and automatically dial down risk as participants age. The fund names typically include a projected retirement year, the target date. Today, many target date fund managers have turned to riskier investments to boost returns, and Fidelity has gone further than its peers, said Ron Sears, president of research firm Target Date Solutions. These funds with high concentrations in stocks are a time bomb, Sears said. The sector is even riskier today than during the 2008 financial crisis, when some funds dropped more than 40%, he said. Fidelity spokesman Vincent Lopercio said today's American savers can handle more risk because they retire later and live longer, allowing more time to recover losses. The Freedom 2020 Fund, FFFDXO, for investors 2 years from retirement, fell 6% between January 26 and February 8, performing worse than 81% of competitors' similar target date funds, according to Morningstar. The sharp downturn reflects Fidelity's decision to keep 60% of 2020 investors' money in stocks compared to an average of 40% in similar funds for older savers, according to Morningstar. The 2040 Fund, FFFFXO, for mid-career savers, tumbled 9% during that period, lagging 87% of rivals, after outperforming almost all competitors over the past year as stocks generally surged. The 2060 Fund, FDKVXO, for young investors did better, beating 60% of rivals during the market sell-off. Lopercio said such short-term swings do not reflect what Fidelity's retirement savers will see over the long term. With its 2014 strategy changes, Fidelity needed to address a long-standing problem with underperformance of Freedom funds, Lopercio said. But the fund's market share has plunged to 21% of total target date fund assets, down from 43% at the end of 2008, according to Morningstar Inc. data. Chaotic changes Dassault Systèmes, a French software company with U.S. operations, is among those who dumped Freedom Fund investments soon after the strategy revamp. Fidelity's tinkering with the fund's methodology for dialing down investor risk over time raised concerns about the fund's management, said Longfellow Advisors, an outside consultant hired by Dassault, in a report to the company. Plan sponsors dumping Freedom funds more recently include a host of college retirement systems that shifted money in 2017 to target date funds offered by Vanguard, according to announcements by the plans. They included Central Florida University, Dartmouth College, Duke University, Santa Clara University and the University of Virginia Physicians Group Retirement Plan. El Camino Hospital in Silicon Valley replaced Freedom funds with T. Rowe Price's target date offering in 2015, citing historic underperformance and the new attempt to time global markets, according to a February 2015 Investment Committee meeting report. Fidelity has made a lot of changes all at once, said Scott Cameron, Chief Investment Officer at retirement consultant Multnomah Group, which advised El Camino Hospital on the change. It does cause clients to pause. It's not the first time Fidelity has been criticized for strategy changes that unsettled investors and analysts. When Morningstar looked at Fidelity's changes in the allocation of stocks between 1996 and 2010, they described them as shocking and seemingly chaotic, according to a 2011 Morningstar report on the target date fund industry. Trying to not lose money instead, Fidelity restricted Freedom fund managers to predetermined asset allocation formulas, with specified percentages of stocks, bonds, or other assets. The Freedom Funds, launched in 1996, dominated the sector for years. As the top U.S. record keeper for 401(k) and other defined contribution retirement plans, Fidelity had outsized influence on what investment options were offered to workers at hospitals, municipalities, publicly traded companies, and universities. Until the changes in 2014, Fidelity funds held higher concentrations of more conservative investments such as bonds, aimed at protecting investors against the downside risk of market cataclysms. Even with a more conservative asset mix than Freedom funds have today, Fidelity struggled to control the damage from the 2008 financial crisis, when the funds performed as poorly as the rest of the sector, losing 41% for the youngest savers and 25% for those near retirement. And the stakes are much higher now. The popular target date fund sector now has more than $1 trillion in assets under management, or more than 5 times as much as before the 2008 meltdown. Fidelity has gone further than competitors in boosting risk to juice returns in a low interest rate environment, fund disclosures show. For example, Fidelity's Freedom 2020 fund, marketing to people retiring in about 2 years, has 60% of its assets in equities. Fidelity's 2020 fund includes 6.4% of its $31 billion in net assets in emerging market equities, such as Chinese stocks, according to company disclosures. That's up from about 1% a decade ago in a similar Fidelity fund for older savers, according to a returns-based estimates by software and research firm Markov Processes International Incorporated. The current exposure is significantly higher than the category average of about 4% in 2020 funds, according to MPI's analysis. Emerging markets, in particular, can be more volatile than the U.S. stock market because they can feature foreign currency exchange risk, political instability, and limited liquidity. In the summer of 2015, for example, the Shanghai Composite Index, SSEC, fell more than 40% in a sell-off that reverberated around the globe amid worries about China's slowing economy. Freedom Fund portfolio managers and quants are experimenting with artificial intelligence and algorithms similar to ones used by hedge funds to identify hidden shifts in the market to adjust investment allocations, according to Fidelity's published research. The changes have paid off in the short run, with Freedom Fund's 1-year and 3-year returns beating internal benchmarks. Fidelity also credited junk bonds for helping bolster returns, according to portfolio manager commentary posted on its website. In the long run, the biggest risk in target date funds is that they won't meet investor expectations for avoiding losses, said Morningstar analyst Jeff Holt. The funds, he said, are so popular in part because investors believe they are designed to not lose money.